Eddie, thank you so much for joining me on today's Dirt to Deals podcast. I'm looking forward to chatting it up with you. I've had one other loan originator or mortgage guy on, and there's a wealth of knowledge, but I like to get some more knowledge on your side. And I even got some questions because, the last time I did this, was probably going in the summertime, and we all know that the market has changed and shifted. But before we get going, tell everybody a little bit about yourself.
Yeah, absolutely. So I'm Eddie Gomez. I'm the founder and CEO of EHG Mortgage. We're a local mortgage advisory and brokerage firm here in Tucson, Arizona. We originate mortgage loans all over the state of Arizona, and we also get into DSCR loans for investors, or business purpose loans, that is what they would call them, in about 35 plus states. I've been in the industry, for the probably a good 7, 8 years at this point, and I launched my own mortgage company back in 2023, I believe it was, and yep, for 2021 actually. Sorry.
Okay.
Yep, but and we started off as EHG lending, and we recently transitioned to EHG mortgage.
Nice. Nice. So what was it like starting off right into COVID times? Was it easier to get your foot in the door, or and now you're seeing it harder to get more loans, or was it challenging because there's so much activity that people didn't know about you? What was it like getting in around that time with
Right.
COVID?
So actually, during that time, COVID was great, right? If you ask anyone that's in our industry, for loan originators, appraisers, realtors, I don't think any of us has seen that much business,
Yeah.
like during the COVID era. But I do remember when I first started my company, that COVID window was basically, closing in. It was, everyone, or you could, see the rates starting to rise up again. So the window of opportunity was going away. Um, so it was a good time to try to get as much business as possible, because you could really feel that window closing in. Um, and since then, in 2022 up until probably 2024, maybe even recently, that window of opportunity has been completely shot. Yeah,
Hmm.
shot. So rates have shot up to close to 8%, depending on the type of loan. Some have probably have been above 8%. Some have been in the high sevens, but you could really feel the big difference, right? So it wasn't as easy as during the COVID era when you could go ahead and throw a rock and get a loan 10 feet away
Yeah, you just had to
from
have a
you.
heartbeat and you were working.
Yeah, you were working. I mean, you guys were probably slammed as well, right?
Yeah.
As appraisers, I remember appraisals were taking weeks, so a little longer than what they're taking now in terms of turn times.
Yeah. Yeah. No, it definitely was an eye opener to the whole industry. And unfortunately, appraisers didn't really learn from that. They didn't learn that we could kind of be the backup, because when you guys are trying to close deals and then they're finding out in certain markets, A, they can't even get an appraiser, and B, it's going to be 3 weeks out, and you're trying to close in 30 days. That's not healthy on the industry. And what we have found shortly after this is a lot of the big money has come in to remove that and become more efficient in creating more of a streamlined system. And one of the biggest ones is going to be the new UAD 3.0 that's going to be, or 3.6 that's coming out, and it's going to be streamlining the whole appraisal process. And what's really nice too is our software in the appraisal report will work really well with the mortgage side. So there's no longer going to be this 60-page appraisal where every appraiser does things slightly different. It's hard to go in and find their information. It's just going to be boom, 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 and it'll be very easy. So
Right.
hopefully
So,
we'll start to
so
see
can you
appraisals.
tell us more about the UAD and what that
Yeah,
is, and
yeah,
who's standardizing that, and how is it coming into play?
yeah. Fannie Mae, Freddie Mac, they kicked it off, and it's going to be implemented. It's already been started for select lenders and select appraisers to start utilizing it. And then in January of this year, it'll become not particularly mandated, but it's going to be highly desired to be used. They're going to put more pressure on the market to start using it. And then in 2027, it's going to become the new mandatory lending appraisal form. And what is kind of
Okay.
neat about it is it's more of a cloud based. And so if I enter in, the subject's information and I say it has an auxiliary dwelling unit, it'll open up a new balloon, and then it'll ask a question, and open up a new balloon, and ask a question, and then it takes everything and compiles it so that it's super easy for lenders, reviewers to just go from top to bottom and get all the answers they need. Instead of like right now, like if you were trying to compare photos or the sketch, you have to keep going, or wherever the sketch is located on the appraisal, you got to go maybe page 39, then go back up to page 2, then back to page 15 to compare with the photos, then back to page 2, where everything's going to be streamlined, where it's all right there together. And so it's going to become more efficient. It's going to be a lot of learning curve for a lot of appraisers because it's new. It's going to be requiring a lot more information from us when we're at the actual house. So, like, typically, an appraiser could spend 20 to 40 minutes at a subject's home, taking notes, doing the measuring, taking in all the data. Now, it'll probably stretch to almost an hour and maybe even an hour and a half because they're going to just be constantly answering a bunch of questions in the field, and again, it'll go through and it'll pop up new windows and new balloons that you'll have to answer those as well. So it'll take more
Right.
time in the field, but it will get much better for the system. Now, this will only be for lending purposes, so that are being sold to Fannie and Freddie. So, like, if you were using me for a private deal, I wouldn't use this. I would still be going back to the old form, but
Okay.
eventually it'll get like this.
So, and why do you think that that's becoming the new standard when it comes to agency loans? Do you think there's just more scrutiny?
They're
The
just trying to
agency
create more
loans.
consistency because
Uh-huh.
in our industry, no appraiser does it the same. No appraiser. I mean, you have your form, but then a lot of appraisers will in the appraisal, there's all these little sections, but it's kind of small, and it doesn't give you a lot of space to put certain information. So then you have what we use as a supplemental addendum, and it basically is like 3 or 4 pages of just white. And you just go in and answer all these questions and put in your support and your reconciliation, and that's eliminated. Like that is going away. So um, my camera likes to move on me when I do hand motions. So what they're trying to do is just make it so that my appraisal, the next person's appraisal, will all generally look the same. and it's going to take away a lot of uh, trying to understand and cross-referencing different things. It's just going to make it more unified, more systematically easier for lenders, underwriters, and everybody involved to process the
Okay.
appraisal. Yeah,
Okay. Yeah,
so it's
because
going to be a big.
I mean, and it's interesting that you bring that up. You know that the new standardized form. It sounds like it's more work for you guys as appraisers, right? In terms of the length of the time that you're having to invest at each
In the
location
beginning, yeah,
and the
in the beginning,
information, right? In the beginning,
yeah.
okay. Because there's also been, you know, a lot of a lot of lenders are also beginning to accept more of the desktop appraisals.
Yep.
What would you have to say about that? The changes that are, you know, coming into the industry, that it's becoming, a lot of it is more, almost you could say virtual.
Yeah,
Is that going to
yeah,
be a new
that's
norm that you think is being
that.
accepted, or what do
Yeah,
you
that
think?
is going to become so on this new form, which is kind of good. Like you would know, but not necessarily the audience. But if you had a single family home, that's a 1004. If you have a manufactured home, that's a 1004C appraisal form. If you have a
Mhm.
multi, that's 2055. All of those forms are all going to be on one form now. So it doesn't matter if you have a
Oh, okay.
condo, a multi, a single family, a manufactured. It's all going to be on one form, and they already are starting to implement with technology where the homeowner, you can send them a link and they will do the review for you. So like so the insurance is already doing a lot of this in the insurance rate. And I think that's where we or the industry is kind of copying it. You can send the homeowner the link, and you will go through and ask them, okay, show me the front door, show me the living room, show me blah 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 blah, and it will take. You could take pictures as it's happening, and then they're all geo coded. So like the homeowner can't be doing a model match house next door, right? It'll show up a
Right.
red flag and say this is not the address that was entered. So it'll tell them like we're not at the right house basically. So I could easily
Right.
see
Okay.
yeah, in the next 5 years you're going to start to see where appraisers are remote viewing the homes from their desk, getting all the
Mhm.
information they need, and then relying on satellite imagery, various things like that to put together. Um, there could be obviously headaches, like anything. By doing remote view, you don't see certain things. You don't get the like if there's smells or if there's deficiencies, you don't get a really good perspective of it, by sometimes. But I think what's going to happen is there's going to become a new error rate that the industry is okay with having that, especially on cookie cutter everyday homes that are easy, and especially if the loan is a good loan where they're putting 20% down, they got good credit scores. It's like we kind of need, kind of like what you were saying earlier, like desktops or appraisal waivers. If they
Right.
follow in this, but they still want to have something that's probably a product that will be pushed more towards those type of loans, but there still will be for like rural issues, um, high valuation homes, condos. There's probably still always going to be uh, an appraiser going out there to walk the property, observe the property, get an idea of what's
Mhm.
impacting the value, and even in certain cases, like, um, if we just like we're going back to like a simple cookie cutter subdivision, you can kind of already look up at the house on Zillow or whatever and see that it's just in a typical neighborhood. then that's fine. They'll probably do virtual. But say the home
Right.
backs up
Okay.
to say the home backs up to an industrial park. Well, now they may be like, no, we want to send an appraiser out there to see what that impact is. Like, is there an aroma coming off of that industrial park? Is there loud noises? Is there certain things that will impact the value? And so there's still
Right.
going to
So,
be certain
okay.
issues, you know,
Right. No, that's interesting. I mean, because anything, even something like that, like the aroma could affect the value of
for
a
sure.
property, in the area, or maybe sound pollution, right? If it's near
Yeah,
an airport. And that's interesting because that's a lot of things or factors that our borrowers and homeowners, investors, they don't really take into account until it's happened, right? But you
exactly.
as the appraiser has to take those factors into account,
Yeah,
which is it's interesting to that it's not something that we're always considering when we're looking at the purchases, right, of these
yeah,
properties
yeah.
in
And
general.
so this new form, I believe, will start to make the appraisal process where you really won't have week long turnaround times. You'll literally have 72-hour turnaround times, because
Okay.
in today's world, we're already seeing the software where you can plug and play a lot of things that pulls a lot of data that helps with support and kind of takes a lot of the extra work that the appraisers would have need to do. It
Right.
starts to condense it and put it in the report, so you're no longer spending an extra 45 minutes pulling all this data, putting it into the report to show the support. A lot of the softwares that we have available are doing a lot of that. So I imagine the
Right.
next couple of years, you're going to start to see that the average home appraisal max should be a week. Now there's still always going to be those
Mhm.
rural properties that are harder, where you got, you know, 5 acres or 20 acres out in Cornville, Arizona,
Right.
or somewhere way
and,
down.
and it
Yeah,
sounds like a lot of it is basically data based. So, I mean, that's what it is. Basically, Fannie Mae and Freddie Mac, I think, since the early 2000s, they started collecting all this data
yeah,
that wasn't, logged. It was all, probably a lot of it was just paper. And then
yeah,
it began becoming logged, right? So that's where you as appraisers are able to, tap into that data and how it's been being built up over the years since then. Am I
yeah.
correct to assume that?
Yeah, no, we don't get to see like Fannie Mae and Freddie Mac's collection. So you have a house, built in 2000 in an urban area that's been bought and sold 3 times. Um, we don't get access to that necessary, but what we do get access to, like a software we use is like Total a la mode. You can put in the subject and it'll show you past peers basically grid. So it'll tell you like what the square footage was for the last three appraisals that of appraisers that have used that comp in that
Mm-hmm.
software. So
Okay.
it kind of gives you a guide to see maybe you're off on your square footage, or was there a change, or maybe the last time it was appraised, it appraised at 2,000 square foot, and then you do the appraisal and it's
Right.
2,300, and you're like, well, what happened here? Then you talk to the homeowner and they're like, oh yeah, we did this addition. Oh, okay. And then and it's another thing for us to look at to make sure if the quality of that addition was done, was it permitted, was it a was it an improvement or an over improvement, or what is that? So
Right.
yeah, there's a lot of
Was it
data out
actual
there.
permits that were created to make that, additional unit,
Right,
or that
right.
structure that was built? Because we have ran into situations like that, and that's why, on our end we have to request from title companies, what the plat map looks like, and the
Yep.
survey, right? If there's been a surveyor out there that's recorded those actual changes.
Yeah.
So it's interesting to hear that. And then something that I've been running into lately, as well as the property inspection waivers. Those came out actually during the COVID era.
COVID.
They became a little bit more. They started gaining popularity during COVID,
Yeah.
and they kind of disappeared for a little bit. But I've seen them come back now. It's become something that is becoming more of a standard, and it sounds like a lot of it is done through Fannie Mae and Freddie Mac's ACE. Yeah, I don't know if you've heard of ACE before, um, but basically it's where they pull the data, right, to be able to issue those property inspection waivers. Do you
Yeah.
know anything about ACE? Can you tell us anything about
No,
that?
I don't have any knowledge set on ACE. As obviously as an appraiser, you don't necessarily like getting the desktop stuff because by the time the order comes through and it goes through the AMC's and then the order hits your desk, you're talking maybe 25% to 40% of the original appraisal fee. And so a lot of appraisers, they don't
Mm-hmm.
particularly want to do those, but it is becoming more popular and it is here to stay,
Right.
and so a lot of appraisers are being forced to kind of jump on that, and even like data collectors, that's a very popular thing now. And
Right.
there's a little
It's
what I'll say is a lot of the resistance that we find is that when we put together the appraisal, we're still responsible, but the third party person that went out and did the inspection and so on, they're not responsible. We are. And then
right.
if we're getting bad data or bad information, and then we put together the appraisal and it comes up as an issue later, at the end we're still reliable. We're liable for that
Mm-hmm.
appraisal. But yet, if we were given bad information, so they're still trying to iron out a lot of the details to make sure that it is the right data that the appraiser gets and that he or she can put together a solid appraisal without it having all
Right.
these added verbiage or
And
release.
and being in such a data driven world, everything's very, we're all moving into artificial intelligence. We're making so much technological advances. There's still this big human factor that
100%.
comes into play, that that's the most important factor, right? Because it's all data driven. But like you said, it falls back on you as an appraiser, and at the end of the day, they really truly need us as humans to come out there and look at these properties and make sure that the data is accurate at the end of the
Yeah,
day.
yeah, you're right. And as the data gets better and the information and technology comes out, that we can become more precise and more of a solid foundation that the data you're getting is accurate, the appraisers will adjust to it just fine. But our industry is struggling because we have a large gap. Like they say, the average appraisers in the 50s, and they have been doing it the old school way. I mean, we have people that still use tape measure. Where a lot of people use lasers or even lidar scanning, and there's so you have a lot of the old school way, but this new people like myself and younger are more willing to use data technology to become more efficient, to get the appraisal
Right.
done in a faster turnaround, you know. So I
Right,
see
and I think that's a lot of. And sorry to interrupt you, Gary. I think that's what a lot of people are having trouble to understand, that artificial intelligence, it's not meant to replace us. I mean, I'm sure it's replacing a lot of certain types of jobs, but not entire industries. But I think it's
right,
being made more to help us work more efficiently, right? To
for
be able
sure,
to
for
reduce
sure.
the workload in the areas where it can be reduced, so we can really focus ourselves in the areas where we do need to focus,
Yeah, yeah,
in terms of situations
yeah.
or, jobs like that as well.
Yeah, no,
Um,
AI will only become a stronger tool. Like a lot of us that already use it, you can find different ways that it's super beneficial. You still have to check the data, and sometimes you're wondering, I could have done this faster, but it's still good to put in the reps to utilize this tool because as it gets better and stronger, you will start to see it benefiting you more. A lot of the things that I do where I use it is I'll just talk into the chat, and I'll tell it my whole process, what I was doing, what I was looking at, why I like this comp versus that comp, or why I even chose this comp versus, and then it'll give me a really nice summary. And then on
right,
top of all my data support, now it has a really good, clear summary of my thought process so that when the client reads it, they have an idea what was going on in my head, you know? And
right,
it just helps
absolutely.
to clear it up. So that's been a really nice thing because sometimes one of the biggest issues they've had in our industry is that we don't support our work. You know, like you're doing adjustments, but you're not giving a really good data or understanding or explanation of why. And so now with like AI, you can definitely on top of your data support, your numbers, you can express why and why you gave this more weight versus this one, and why you use this one like this comp that was a year old versus a comp that was 60 days old, you know? Um,
Right.
and so
Yeah.
it helps, yeah.
Especially when, let's say, a client requests a reconsideration of value, which, for those of those in our audience that don't know what that is, it basically, an appraiser gives you a value on a property, and during a loan, let's say we're underwriting a loan. We believe that the value is higher than what the appraised value came in at. We do a reconsideration of value, but we have to provide some of those comps.
Right.
In the past, I've reached out to you personally to assist me to fill out that form to actually
Yeah.
get some comps that in your professional opinion are actually better comps than the ones that were provided in the appraisal itself.
Right.
But now you can you know actually implement some of the tools that AI provides you with to actually assist you in situations like that as well.
Yeah, absolutely.
um,
There's a lot of ways, and this is a good example of where the appraiser is still going to be needed, or just a knowledge set, because the appraised value comes in low, and you want to protest that with a reconsideration of value. If you have the knowledge set like an appraiser, then you kind of understand more what you're working with, and then by choosing a more supportive comp, that can help you win that ROV. And you're
right.
right. The AI can help you to a degree, but again, without
Hmm.
knowledge of that local area or the
Hmm.
strengths or weaknesses, and that's where the knowledge of the appraiser is stronger
Right,
in this
because
current stage right now.
it's subjective at the end of the day, because at the end, it's sometimes you'll plug in, in Chat GPT or Copilot, whichever, you
Yeah,
use. You can plug something in and you ask it, and then you're like, no, 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 this is completely wrong, right?
100%.
Not saying that it's completely wrong, but you will be in disagreement sometimes with what AI
Yeah,
states, because at the end of the day, it's not human. It doesn't understand factors like we do, that come into play.
yeah. And the other thing is too is like AI is an evolving tool, but if you're not an appraiser or a person that's constantly working with AI, you may not have it set up for to give you the best answer, or your prompt is not the
Mm-hmm.
right prompt to give you the right answer. So if you're putting in kind of like bad questions, you're going to get kind of a bad answer back because AI just wants to give you an answer. Um, and
Right.
that and your prompt, your way of asking that question may provide you an answer that's not detailed or it's very wide just because AI wants to please you with an answer. So it
Mm-hmm.
takes, it's very important as anybody in any industry is to become more knowledgeable about the AI and utilizing it and making sure you're using the right type of AI to give you a deeper thinking answer versus just a quick answer, and then
Right.
understanding how to put the prompts in. When you do, man, it's lights out. I had a situation where I was hired to do an appraisal on a land value out in Waddell, or no, Whitman. And
Okay.
the real estate agent, listed the 5 acres for like 599,000. And my appraisal came in I was coming in at like 75,000.
Right.
So I went, yeah, and that's a massive difference. You know what I mean? And even myself, I mean, I make errors. So I was like, what am I missing here? There's got to be something. Why did this agent feel that it's worth 600,000, but I'm not finding that, And what was crazy was on this little area, you go just a couple blocks to the east, and that the support was there for that value. And so I used chat, and it told me that the zoning for this little area fell into Luke Air Force Reserve zoning, where you cannot build a home. You're allowed to use it for storage, agriculture, but you cannot build a site home. But just 2 blocks away, it falls out of that zoning, and you can. So that was like,
Wow.
yeah,
Wow.
that was a great way that chat like made things a lot easier for me. And then I asked it to summarize it so that my client could understand this, and it did.
Right. Correct.
Yeah, and it was just like it was a massive shift, like because like I said, when I was trying to find the comps and stuff, there just wasn't support, but yet 2 blocks
Right.
away there was, and I was like, there's a big piece of puzzle that I'm missing here, and then by using chat and giving it the right prompts, it highlighted that, and I was like, that's the
Yep.
piece of the
So
puzzle.
so it's important to become an early adopter.
one Hundred percent.
We're those of us that are adopting it, we're getting ahead, by
Yeah,
using it and leveraging it, to our benefit.
yeah,
On coming back to property inspection waivers, I did have this one transaction everyone's trying to close before Christmas. And basically, it's a transaction being sold through one of the bigger real estate brokerages out there, similar to Zillow.
yeah,
But basically, this property was purchased in October, and then it was listed in November. So our underwriter, conditioned us for a property flip condition, basically saying that we have to provide invoices to provide evidence that substantial renovations were made to the property to
Sure.
dictate the new value, right? Because when it was originally purchased in October, it was going for 375, and now it's upwards of 450. So when the underwriter reached out and stated that we have to actually provide substantial receipts or order an appraisal, in my mind, I'm thinking, well, we got to get this closed soon. We're already, in December 5th, that date was probably December 2nd, but we got to close by, the 19th, and the closing date is coming up soon. Everyone's working at half the speed, or a lot of the companies are right now. So we're depending on a lot of factors.
Right.
Our priority is trying to close right now. So what we ended up doing, or what I ended up doing on this transaction, is that I contacted the underwriter. I pulled up. Before contacting the underwriter, I pulled up our AI software, and I asked, hey, help me find some guidelines that'll help us, battle this condition. I put it in the perspective that, look, when we did the PIW and pulled the automatic valuation for that property, it was coming up at 452, and that was back in October. It's now December. We're still, and so I don't believe that even through the AVM, I don't believe it would have changed that much in value since then. So
Right.
I backed up my argument stating, look, the AVM still stands for itself, but I used our AI software to help us reference the guidelines, because there's so many guidelines in the Fannie Mae and Freddie Mac handbook that we have to sift through. But I needed something specific to back up my argument. I went back to the underwriter. I let them know, hey, this is what's going on. This is my argument. Can you please check to see if there's any way that we can override this condition, right? Requiring
Yeah.
the receipts and invoices and whatnot, or an actual appraisal. So she ends up calling up to Freddie Mac, and she comes back and she clears the condition for us. Just in this particular situation, it's something that would apply, but that's how we ended up leveraging AI to be able to get
Yeah.
through a tough situation like that when
Yeah.
you're in a time crunch right now,
Yeah. No.
right? Especially
And
before the
it's
holidays.
yeah. You're definitely going to see, and that's where, like, going back to the new use PAP and everything, the URAR 3.6, and that
Mm-hmm.
streamlining everything is going to become more of a useful tool for the future. Like,
Right.
and you're gonna see that the industry is going to, because especially with uh, non-commercial work, typical single family stuff, that's a lot of transactions that happen year after year, and it needs to become more efficient. And COVID
Right.
really exposed a lot of our weakness in the industry as a whole. And so they're spending a lot of time, a lot of money in making our industry more efficient, so that it doesn't take an egregious amount of time to close anymore. And
Right.
so with AI, I think it's only going to get stronger. Where you're going to be able to utilize tools. I mean, I imagine just like what you're seeing right now, where you're using it as an off tool, you're going to start to see it integrated in your software. And I could easily see that in the next couple of years, where, like, even my appraising software, it'll have that AI that you can go to and just work with it, and it'll probably do amazing things. Like reviewing the appraisal before submitting, so that it reduces the revision rate, and that's the other thing about this
Right.
new form is that it's going to reduce the nonsense revisions because a lot of the revisions are the underwriter doesn't know where the hell the appraiser put that added verbiage, so they just fire off a revision, right? And then that adds another day delay because then the appraiser's got to respond to it and then point it out that it's on this page. This new form is just going to right there be so easy. And then when a revision is done, it's going to be stated on that appraisal form. So like everybody from start to finish is going to see that a revision was required here, it was edited here, another one's but it's going to be pretty impressive, really, because, and again, a lot of the terminology, a lot of the condition ratings, quality ratings, it's all going to be unified so that the whole industry understands everything. Like one of the things, if I'm remembering right, uh, we're going to get rid of GLA, and so
Okay.
you're going to have above grade living and below grade living or detached living. It's no longer going to be GLA, gross living area, because
The gross living area. Uh huh.
they're trying to eliminate verbiage that causes confusion um, for the underwriting and so on. So yeah, I totally agree.
Right.
Like you have to start adapting yourself to this technology, or else
Yep.
you're gonna just be
Yeah,
replaced.
it's important to adopt it, and going, just for the audience's reference, what requesting that exception from Freddie Mac, through the underwriter, that and it getting approved, that's like 1 in 100. It's not
Yeah,
something that's normal
that,
by any
yeah,
means. So I don't want
yeah,
everyone expecting that, okay, Chat GPT AI, it's going to solve every single issue. That was,
yeah.
a
No,
long shot. But
yeah,
if you're able to present your argument well, and you can pair it, with the right tools to really make a strong argument, then, by all means, it'll help you facilitate your work at the end of the
absolutely.
day.
Yeah,
But
yeah,
I did want to go back. So we were talking at the beginning, of our, podcast here. We were talking about how, the industry has changed. What business has looked like since COVID up until now. I know that you also went through the same experience as myself.
hmm,
We all saw, some, a change in, the amount of business that was coming in. We were, during COVID, slammed with a lot of business, and then we could feel, that the business, kind of slowing down, and then now it's beginning to pick up a lot more. But since then, a lot of us have had to, change, do something different, right, to be
yeah,
able to maintain our level of business. So I'm curious to find out what did you start doing in your own personal business? Getting all the loans from the big mortgage lenders and the
yeah,
big, the big. I think you called it the big four, appraisal
yeah,
companies, right? Because you go through appraisal management companies. What have you, gone into now, right? I believe when we spoke earlier, you mentioned that you're working more in private work. So can you
yeah,
can you tell me more about that? I'm curious to find
yeah.
out about that.
So when I was, just like you woke up and you had a deal waiting for you, and I'm always a big believer in customer service and doing what you can do for your clients and so on and so on. And like even if I got a revision, like I'm talking like hour that I would have it back. Like I always believed that you treat the customer like gold. And so even when we were busy, I never had an assignment that was late or pushed out. I was always quick to make sure that we had no more than a 72-hour turnaround time. I would literally set up the inspection and then type it the next day. And then when the industry, obviously, with the rates went up at the tail end of 22, 23 is when we started to really feel it. And I was amazed. I was amazed, like, the when that valve turned off, like you're going
Right.
from 40 to 60 orders a month down to 8. And I was like, oh my gosh, I didn't expect, I figured a drop, but I didn't expect it to be that much of a drop.
Yeah, it was
And
drastic. It
it
was
was
very
major and
drastic.
drastic. And then there was a period of time where there just wasn't much action happening at all. And then as we've gotten over like the last year, the the market has gotten busier. But what's happened is ever since COVID, there's like I call them the big four, but there's these larger appraisal management companies that have brought on a lot of staff appraisers, um, and they become more competitive, offering various things. And when it slowed down, the appraiser still has bills to pay, and so they're if they were like a sold shop or have 4 or 5 guys under them, and then all of a sudden they don't, and there's no orders. Well, a lot of appraisers just went to work for the larger companies because they could work kind of hand in hand with the lenders and say we can guarantee X amount of volume and we have X amount of appraisers. So if you send the orders our way, we'll make sure that it gets done. And so that's what's kind of happened is if you can take on high quantity uh, appraisals, you're getting the largest amount of the work. And so what's happened is the volume hasn't picked up enough yet where the spillover comes my way. A lot of the big four are still able to manage those orders, and there's not a lot that comes over our way. So two years
Right.
ago, 2 years ago, when I saw this was happening, I quickly realized I can't be dependent on lending work, and I'm going to have to pivot and start establishing myself more in the private sector. So what the private is, it's like when someone passes away, the estate needs to settle or probate, they need to get a valuation on the person's home, or you have dissolution of marriages and they got to split up the assets, or another big thing that I've been very busy with this year is people paying to have an appraisal done ahead of time so that they know where to go to the market to list their homes. And one of my best clients are actually agents because unfortunately a lot of homeowners, which is understandable, they're not living and breathing their real estate market like we do. They're like, well, 3 years ago the house sold over there for 1.7 million. I want to get that. And it's like, yeah, but 3 years ago was a different market. So what the agents will do is reach out to me. I'll do an appraisal, and then we come back and it's like 1.45. And they're
Right.
using that as a like, hey, this is where here's supportive numbers. This is where a realistic point to list a home is. And so we've been very busy in that area. Is a lot of pre-listing appraisals, but yeah, I had to pivot, and it's been a great opportunity. And I know when the lending picks up more, then it'll just be more work for us. But Yeah,
Yep.
you have to stay fluid in this industry. That's for sure.
Right. Yeah. And it's all about looking for opportunity, because that window of opportunity, it just closed, it closed off for so many,
Yeah,
professionals, and we've lost a lot of professionals in our industry.
yeah,
Um, but a lot of us that are still in the industry, we've had to, find that opportunity elsewhere, right?
yeah,
And in different niches or different, partners as well. I'm sure you've partnered up with family attorneys for some of those appraisals. I don't know
yeah.
if you work with family attorneys
Yeah, no,
um,
you're right.
for
You
referral
have to go out,
business.
and that's going to happen as the industry keeps going. You're going to have to become your market expert. You're going to have to become that niche person or that
Mm-hmm.
real asset to the market because there is going to be a lot more changes. There may be a day where you don't even need an agent. There may be a day
Right.
where you don't even need an appraiser. Because it's a
Right.
simple cookie cutter 1,500 square foot home that's got plenty of data. They may not even need me to appraise it because there's enough data. And if they can just like an AVM, uh,
Mm-hmm.
or like a simple virtual uh, valuator, then they don't even need the appraiser because the error rate is small enough with enough data that they're like, why pay $500 or whatever to have this appraised when we got enough data here to support the valuation? So,
Right.
as an appraiser, as an agent, you're going to want to become that more, or even like yourself, you're going to want to become that person that is the expert, that is talking to its market. So you may
Mm-hmm.
not, like even myself, I do a lot of consultations. I had a call yesterday. I did a past appraisal for this guy. He wants to buy this house. And he called me up and he's like, hey, I want to buy this house, but I think it's overpriced. So we just had a consultation for an hour over the phone. We looked at different comps. We looked at this, looked at it. I didn't do a single appraisal, but we just talked as what a number would be good. And
Yep.
so
Yep.
there's a lot of different ways that you can still use your knowledge and your skill set and pivot in a way that you can still be useful to the market.
Yeah, absolutely. And like I said in the past, I've used you as our internal professional opinion, right?
Right.
In the past, because that's something that's outside of my expertise. I need an expert like yourself to actually help me with that. Or you've been kind enough to, when I do reach out, for a quick phone call, you'll tell me, you'll give me some advice on different scenarios and
Yeah.
whatnot, and what you think is the best route or how to approach a certain situation,
Yeah.
from your
And
professional
that's
opinion,
gonna be
which.
needed moving forward because the more relationship building you can do, the stronger you're
Mhm.
going to be. If you're you can't wait for because those COVID days are never coming back. Like that was a one off. And so you
Yep.
have to be constantly networking, constantly available, bring a value to your people because that's the only way it's ever going to turn into a future transaction is if you're bringing value with no expectations, and that's what's going to
Absolutely.
set you apart.
Absolutely. And I mean, and to let the audience know, you have my stamp of approval, all the way.
Yeah,
Gary
thank you.
Eaton, and it's 316 appraisals, right?
Yeah,
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 316 appraisals. I mean, in another area where I believe that your expertise can come in handy is for the investors, right? A lot of
yeah,
them are looking to, develop. There's a lot of new construction going on, And of course, they need to come up with what can a property be worth, at the time of construction,
Mhm.
if there's no, it's just land, and then you're going to build something on that property. You're going to need a professional, appraiser to tell you, how much it'll cost to build that property, what will be the after repair values, and that's where you can come in and assist with
Yeah, we
that,
even
correct?
we even do a lot of consultation work with clients that are wanting to do a remodel, right? And say the average home in the area sells for 600,000, and they want to go lights out with the remodel their kitchen and the bathroom and so on. But then one of them will say, you know what? Maybe we're gonna dump too much money. Why don't we reach out to somebody, and then I'll get that call and I'll talk to them. Okay, how much you looking to spend to remodel your kitchen? Oh, we're gonna do this. We're gonna put in the sub zeros. We're gonna put in
Yep.
a this, and it's like, okay, that's great, but you're gonna over improve. Your
Right.
market
So,
cap
okay.
is 700,000. If you go dump 200,000 into your kitchen, you're not going to get that 200,000 ever back. You know.
Right. So give us that golden, nugget. Like what factors make an investment property, more attractive to appraisers that are, or what will actually influence the value the most, if I'm an
Yeah,
investor looking to, fix a property up and there's something that I really need to, improve to really get that value up? What would you say is the biggest,
sure.
factor?
One of the things is just study that market. Like, say you hear of a deal and it seems like a good deal. It's an elderly couple that passed on. The home is dated, hasn't been updated in 40 years, and the estate just wants to dump it because the kids don't want to take care of the house. They just want they just want to close the estate. And so an investor comes in and it's like, yeah, we can buy this home. And that's where they have to start doing the research and the homework to know your market. Paradise Valley is a good example where you can buy
Okay.
a home in Paradise Valley on an acre lot. The land value alone is could be $3 million. Okay, so say you're buying the house with for 3 million, and there's a lot of opportunities. You can put in a little bit of money, or you can put in a lot of money, or you can put in an
Mhm.
absorbent amount of money because the land value and the options are so much greater. Where say you bought the house, you don't want to scrape the house, but you go in there, you just quickly remodel it, and you can get in and out of
Mhm.
there and make a really nice profit because
Right.
you could almost do anything, or you could scrape it, and now you got the acre
Yep.
lot. You put a 12,000 square foot home on there, and that changes everything. But that's a unique
Mhm.
area. Not all areas have that ability. Some areas
Right.
you buy the house for 400,000, and you're thinking, okay, I'll put 75,000 into it, remodel it, but then you go to sell it, and the selling price for that typical area is 525. Well, by the time you pay commissions and all this, you haven't done anything. You put a lot of capital at
Wow.
risk, and there's the market's just not there. So that's where
Wow.
investors will talk to us and kind of like, what are we seeing? Blah blah
Mhm.
blah. Is it even financially feasible to attack this deal? And
Right.
sometimes it still can be because what they'll do is they won't remodel the kitchen, they won't remodel the bathroom, but they'll slap some new paint up, put some new floors.
Mhm.
They're in and out of that for 18 grand, and then they put the house back up on the market, and it can clear 15, 20 grand. Well, that's not the worst if you only had to put in obviously the capital to buy the house, but the 18 grand to make 20 grand, that's not
Right.
the worst. But you really just have to know if the market is able to support that. Like I had a client that bought a home in a typical surprise neighborhood, Pulte built, and she built the house, and then she dumped a crap ton of money because she thought she was going to be there for a long time. She hired me, and I told her, you way over improved, that the market is just not going to support what you put in. Like
Right.
she bought the house for like 425, and then she put in 250 into it, putting
And
very nice flooring
and
and
that's why
very
it's
nice
important
cabinet.
to talk to an expert like you.
Yeah,
Sorry.
yeah,
Sorry about that. Yeah.
yeah, yeah. There's a lot of ways you can do improvements and get a good return, but there's a lot of ways you can do over improved and you'll never see that return. And you would like to think like
Right.
there really is a skill set. So like going back to the luxury market, when you
Hmm.
Paradise Valley and Arcadia are really good examples. You can walk into a $3 million home, and then that's a total different market versus walking into a 6 million or a 10 million. But to the average person, they both look really nice. But you have to really know that market and know who the architect was, who's the builder, who was the designer, where did this flooring come, where did these cabinets get made,
Yep.
where they, because those are all massive uh,
Hmm.
factors. I had an appraisal where I did in Paradise Valley, and I wasn't when my first numbers, just pulling data to bracket the subject, my value was coming in at 4 million. Well, then when I found out who the home builder was, that changed everything. That added $1 million to it because there's enough support to show that homes in this area built by this builder drive a higher price tag. So there's support there. So
Wow.
there's a lot of little factors that
Hmm.
that you have to take in consideration, and then just knowing the market, really studying that market area. So like I've noticed that a lot of investors I deal with, they hone in one area. They live and breathe that market area. Not too many of them are in Marana and then all the way down to Vale and then all the way up to Phoenix. Not too many of, unless it's just cookie cutter, very simple, slap the lipstick on a pig and turn it. Most
Right.
investors stay in the Marana area and just work that because they know what the cost is to paint
Hmm.
that 2,500 square foot house, how much the flooring is
Right.
going to be. They have those numbers dialed in. So it's all about how much can we execute the purchase for. And 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 so a lot of really good investors don't even really need me because they bought and sold 4 or 5 times in that area. Their formula already works. They just need to know
Hmm.
where they can buy the home, what the price they can buy the home at, right? And then they just rinse and
Right.
repeat the same formula.
Right, rinse and repeat. Yeah, exactly. The
Yeah,
same formula. But right now, I mean, you offered, I think, a huge golden nugget of knowledge. Right.
yeah,
I think going into the question, when I asked it, I was expecting more of, oh yeah, you can remodel the kitchen and that'll raise the value and whatnot. But the fact that you totally went a completely different route and you're actually talking about what could really influence the property going into the project itself, and with the location, that's I think something that a lot of homeowners and investors forget about, especially if
yeah,
they're amateur investors, right? I'm
yeah,
sure a lot of the larger investors already account for those type of factors, but going into your first investment as an amateur, it's make it or break it.
Yeah,
And
and
if they
one of the
break
things
it, they might
to
be
answer
scared.
your original question, the
Hmm.
as an average homeowner, and they're like, we've been here for 5 years, we'd maybe like to sell in 3 to 5. What improvements could I do? It is always the easiest. The kitchen, the bathrooms, those are always by far the largest driving force, um,
Right.
especially when you are in a typical cookie cutter area. Those are
Yep.
the factors that really. But you just got to pay attention. Like, go on to your online resources because not everybody has access to MLS. But go on to your Zillow. Look at the closed sales, not the actives. Look at your closed
Hmm.
sales and see, oh, they did this to the kitchen, and oh, they use Samsung appliances. They didn't have to go and buy GE Profile or this. You know what I mean? Like, start studying what other houses have done in your market area, and then that kind of tells you, okay, we could utilize IKEA cabinetry. I don't have to go pay
Right.
$60,000 to have custom made cabinets done. I could use those cabinets that are already pre-built and just hang them and stick them and put soft closing hinges on it. The market will like it all the same. You know what I mean? And so that
Right.
for a homeowner, that would be just before you go out and do things, especially if you don't see yourself staying long term. Um, just look at what others completed sales have done in your market and study the improvements because sometimes especially on like newer bills, let's say 23 and newer, you know and they say it was like a base model where they use uh you know instead of like they use not necessarily Formica, but they use that cheaper countertops where now you can upgrade it to quartz, and that can make a massive change.
Okay.
Especially with like that
Right.
their
Absolutely.
rainfall edging, where it looks like the countertop goes right down to the floor. Updating, I mean, simple things like even updating your faucet to the newest fad can have a higher uh, market reaction that's really cheap to do. And so instead of
Yeah,
prepping
those
your
subtle
brain,
details that you
yeah,
can change, right? Will add
yeah,
a lot of value.
100%, yeah,
Wow.
and look for the common trend that's getting the market reaction.
Right. It's not always having to add all these additions and over improvements and
Exactly.
whatnot. Right. Okay. So my man cave probably wouldn't help add value, right, to a
Yeah,
property.
yeah, it's funny you bring that up. So a lot of I get quite often, does this count as a bedroom? Because it could be like a little
Right.
office or a little den or something like that. And the people are like, oh, it doesn't have a closet, so does it get counted as a bedroom? And in zoning or not zoning for permitting, maybe when the house was built, didn't have a closet but has a window.
Mm-hmm.
Yeah, technically
Yep.
that's not a bedroom. But for us, it could also determine a market reaction could determine if that's a bedroom. Where if we look at a market area and we're seeing that a lot of people are using that den as a bedroom, then that den has more value because if you live in an area where there's a lot of young family, you got 3 or 4 kids, they're going to use that den as a bedroom. So
Wow. Yeah.
yeah, so there's a lot of little things like that some people will do things, make changes in hopes that it adds value because they think, oh,
Yep.
if we add, say it's a 4 bedroom, 2 bath house, and they got that den, and then
Yep.
they're like, oh, let's turn that into a bedroom. Well, some markets, that bedroom, you didn't need to do that. it was more desirable to be an extra space for the office or the
Hmm.
man cave or the study room or whatever. The It was better to leave it like that. So I had a deal in Scottsdale where it's more of retirement people, empty nesters. A lot of the homes in this area are a two bedroom, two bath with an office. And that third bedroom did nothing, absolutely did not change anything because the market reaction is they like to have their office. So they much rather have an office with French doors or just be in an open, where they could plug a desk in, not be able to close the doors. So there's certain markets where not always adding bedrooms or bathrooms is a plus.
Right. It might
A
not be
lot of
the
times,
improvement in that
yeah,
market.
right, right,
Okay.
yeah,
Yeah, no, it takes me back to a deal that I had myself. This one property, I believe it was a den that was turned into a bedroom, right? And I think it did happen to have a window, but the appraiser wasn't counting it as a bedroom. So what we did is that we actually looked at the local zoning laws here in Tucson, Arizona, and what deemed it a bedroom, right? What and the permitting, right? That's or I guess in the code, right?
hmm
The zoning code. And we came back to the appraiser. We told them, hey, this is, what we got. Are you able to use it to, count that as a bedroom? And they
yeah,
worked with us and they were able to actually add it and we got
nice,
the value that we needed. Yep.
nice. Yeah,
So it's
no, it's
important to look at those factors.
100%. Yeah, and then another thing that's it's kind of this weird gray area. Like a lot of older communities, the homes are built in the 50s. You'll see that they did an addition, but it was never permitted. And so
Okay.
like tax
Mm-hmm.
records shows it not being there, but it's there. And so
Yep.
people ask us, well, how do you play that out? And one of the things is it has to have the same functionality as the rest of the house. So,
Mm-hmm.
are you walking into that extra room, stepping down or stepping up? Does it have the same heating and cooling? Was it built to the same quality of construction as the rest of the home? Right. So, in some ways, that addition still has the same value as the rest of the house because it does meet all those criteria. But we still have to state in the appraisal, like, hey, this 250 square foot addition is an unpermitted addition. However, the market reaction is still going to be positive because the quality of construction is equal to the home. It has the same heating and cooling, and so on and so on. But then you have sometimes where people will do these prefab additions, and they don't have like an agent might call that a living area, but that's not living area. It doesn't have the same heating and cooling. It's not the same build as the rest of the home. So there's a lot of little things you really do want to do, some education on before you pull the
Yep.
trigger on doing add-ons.
Yeah, absolutely. The devils are, or the details are, the devil is in the details at the end of the day,
Yeah.
right?
Yeah,
As the saying
especially
would
like
go.
garage conversions, the I had a client reach out to me, they did a garage conversion and they were wanting to know if that would add to the square footage. And I said no. I said A, it's unpermitted. B, it's going to be counted, but it might have an actual neutral impact because yes, this could be used as a living area for a rental because there's like a two car garage with a single car detached, right? And they converted that into a living
Right.
space. And
Oh, wow.
yeah, and so I like talking to them. I said it really doesn't benefit you to add that or really bring a highlight to it because your market area really likes 3-car garages. It doesn't like
Right.
2-car garages. So now losing that 3rd-car garage to a detached living that the only way you can access it is by
Hmm.
leaving the main house, walking across the driveway, entering from a side door, like now that became a
Right.
unique property because the next buyer's got to find that to be useful. So sometimes people
Right.
do
Right.
things and they hope that it'll be counted, but you got to study your market area because not all improvements are going to bring back a high yield.
Yep. Yeah, and I think
Yeah.
that's important to mention because there's you're basically debunking a myth in the industry and online. There's so much of the online, guru personalities that, they mention. Yeah, turn your garage if you have a 2-car garage. You can turn one of them into an extra bedroom and add an extra value to
Yeah.
it. And then you have all these investors, amateur investors that go out and do that and it doesn't yield that much for them,
Yeah.
right? But if you have
Yeah.
a professional like yourself that can really
Yeah.
assist with
Yeah. You just
consulting on that
got to
subject,
study your
it
market
helps.
because so like where I live out in Rio Verde, garages are very big, pools are very big, and
Hmm.
and and then in some market they don't care about garages, they don't care about pools. So you really have to before you go and do anything, you really want to make sure, like yeah, even out here, maybe somebody wants to have a 25-car garage. Okay, well, that's going to
Right.
cost you probably a half a million to 750,000 to build to match the same quality of construction as your home, but you'll never get that back because there's not a demand for a 25-car garage out here. Um,
Right.
maybe an RV garage, maybe an RV and a boat garage, but not a 25-car garage collection. So
Right,
another,
and that's probably why you see a lot of like the luxury homes as well. I mean, on the really higher scale, they might sit on the market for a long time, months, maybe
yeah,
even a year, because of
yeah,
those types of additions that not everyone is looking for. It's a very unique addition to the property itself.
exactly.
Correct.
Yeah, I had
Hmm.
an appraisal last month. A guy, he had a really good sized home up in Cave Creek. It was about 3,600 square foot with a casita. And when you first walked up to the house, you would never have known it because the roof line flowed just perfect. But the guy had a full on basketball court in his house. And I was
Uh-oh.
like, oh, wow, okay. And I did a 20-mile radius search for an indoor basketball court, and there was nothing. And so when I gave the guy the appraisal, he's like, so you didn't really give me value for the basketball court, huh? And I said, I did. And he goes, well, would that count as square footage then? And I said, no, because the functionality of that is you're not going to go sleep in there. You're not going to go watch a movie in there.
Hmm.
That's got one purpose is a sports court. It's not, I mean, you could throw a party in there, sure, but it's not going to be a gathering of a family.
Right.
And
Right.
so he's like, so how did you use a value for this? And what I ended up doing was choosing homes that had a large detached garage or an attached garage that was similar in square footage, where they do have like an RV, a boat, and two
Hmm.
cars. Because in that area, you do have these really elaborate detached garages, and they're literally about the same size, and the cost to build those would
Okay.
literally be equal, because other than the wood flooring in the basketball court, the structure's still the same. And so that's how we ended up solving that puzzle. And he was like, the appraised value came in a little bit lower than he was wanting. And I said, the problem is you need to understand that your home is such a unicorn. Like you're talking like if you had a pool of 10 people, you're talking one buyer that's going to walk into that house and say everything match like this is exactly what we need. And it really
Right.
was designed for a younger family. Well, how many younger families can afford a $2 million home? So I said that really hinders your marketability, and
Yep.
so yeah, so it's different
And
when
and
go ahead.
and maybe they don't like the answer when you give it to them, but you do the right job, in educating them when it comes to
Yeah,
that and
and
with the
and
reasoning.
and another thing I always educate my clients is you could always list the house higher than what I gave you, but this is a supported number. If my appraisal is under review, I can support with the data I have. This is the value. Because like we all know, real estate is very fluid, very highly driven by emotions. Um, Another person, I mean, they could find that one person that walks through that door and is like, yes, I will give you 2 million for this. I'll give you 2.2 for it because they want that home today, right? And
Right.
so, but for me as an appraiser, I can't base off of emotions. I had to base it off of data. And so sometimes the
Facts,
data,
data. Yep.
yeah, and sometimes it comes back and that's not the number they were hoping for. But
Yeah, and it did cross my mind earlier, as an appraiser, it must be a tough job because you really want to help them out. You really want to, as a person, want to give the value that they're looking for, but it's your job to really be subjective and give an accurate value because at the end of the
100%.
day, it's protecting, whether it's the consumer or the lending agencies,
Exactly.
whatever it is, but you have to. It's your job to be subjective
Yeah,
at the end
and
of the
and
day.
that's where the personalization, the ability to have customer service, and really
Mm-hmm.
also because like for me, like when I do an appraisal, like, even though it is usually a one-off transaction, I really try to let them know like I am here for you. You have hired me to come and give you a value, and part of that comes education. So I tell them I will take as much time as we need to walk you through the whole appraisal process because the average homeowner gets 4 appraisals in a lifetime unless they're an avid mover.
Mm-hmm.
You know what I mean? So the last time they looked at an
Yeah.
appraisal was maybe they glanced at it when they bought the home. You know what I mean? It hit value, so they didn't care. So when I do give an appraisal, I let them know like, hey, we if you have 100 questions, I'll go through 100 of those questions and educate you because my goal is when they walk away that they're more educated about the process so that in the next appraiser, if it's used by me or their next home purchase, they're just more qualified to understand what the whole process of evaluating a home, because
Right.
uh,
Yep.
yeah, and to me, educating the people is way more important than just providing them a number and collecting my fee.
Yep. Yeah. At the end of the day, that's what separates you, from the competition, and from other appraisers in general, and myself as well, in the lending world.
Yeah,
In our brokerage, we're trying to really focus on actually educating, right? Because
yeah,
that's what makes the biggest difference. No one likes going into a transaction blind and just
right.
being told what to do. We want to know why we're doing what we're doing at
Yeah,
the end of the day.
I'm
So it's
gonna I'm
it's
gonna
really
ask you
important to educate. Uh-huh.
in this current market, like how should someone prepare, you know, going into a purchase or thinking about refinancing? Like
Hmm.
like if you have a young couple, they're got some credit cards stacking up and the rates have come down. So now they're thinking about buying. And say they bought 4 years ago, 3 years ago, last year. What are what are some things that homeowners could do, or maybe before they start this long process, really look at before they make that call? What are some of the things homeowners could do to know if it's even feasible or practical to even do?
Right. So, I mean, at the end of the day, um, the best way and the easiest way to look at it is let's look at, and because us as lenders, we're going to look at what's called the debt to income ratio, right? So
Mm-hmm.
basically, we look at what are your total monthly liabilities, so your credit card debts, card payments, all of that, right? What are those monthly payments? And then what's your monthly income gross, right? We're
Mm-hmm.
looking at before taxes, before deductions. So it's important to look at those two numbers and put it together. We call it the debt to income ratio. Basically, you divide, debts divided by your income, you'll get a percentage, and that percentage will dictate what your debt to income is. So typically, Fannie Mae and Freddie Mac, they'll accept, 43%. FHA loans will go all the way up to 56.99 with compensating factors, right? But does that mean that's the right answer? Just because it fits
Right.
within your debt to income ratio, are you supposed to go, ham buying, the most expensive house or refinancing or doing a debt consolidation, whatever it is? That's not always the right answer, right? The right answer is
Mm-hmm.
really what fits within your daily life. And, as a good rule of thumb, you want to keep that mortgage payment, within 25 to 30% of your actual income, right? You don't want to overspend,
Yeah.
because you're going to put yourself in a really tight position. So I think that's the best way and easiest way as an individual to gauge how much you can afford without actually going out and speaking to a professional like myself. Once you go and speak to a professional, like myself or one of our brokers, they'll be able to give you a very accurate answer of what your debt to income ratio is, how each property will be different, because you're not just looking at putting a down payment on a house and what the loan amount is going to be. You're looking at property taxes, you're looking at mortgage insurance, you're looking at hazard insurance, you're looking at HOA dues as well. Every property is
Yeah.
going to be different. So it's
Yeah.
very important to take those factors into consideration and try to find something, or, the right home that fits within your means, and not trying to go out and compete with with the neighbors
Yeah.
and try to get the nicest, biggest house that you can find at the end of the
Yeah, you
day.
bring up a good point because I've done appraisals where the house was really reasonable, you know, but their HOA fees, bro, were crazy. And I was like, like that's gonna make a big impact at the end of the year when you're paying $300-400 a month in HOA fees. And
Yeah.
I was like, that changes your numbers quite a bit, like. And so,
Oh
because you're
yeah.
right, like you have to think in your insurance and all these other little things. It's not just a payment; it's all these
Yeah.
other things that play a factor.
And can it go up is the biggest
Right,
question, right? Because
right,
your HOA dues, they're going to go up. Your property taxes, they're going to go up. Your
yeah,
homeowner's insurance, it's going to go up. So you have to take into consideration that these are all going to go up. So you don't want to be stuck at 50% of your income going towards your house, your mortgage
right.
payment, and then all this starts going up as well, and now you're left with 40% of your income, 30% of your income to spend on food and on, actual expenses, living expenses, that you really need. at the end of the day. So
Right.
um, maximizing the debt to income ratio to 56%, or even on VA loans, you can go up to 60%. There's no actual percentage. It's all based on what's called automated findings, but you shouldn't maximize it. It's
Yeah.
really, you have to be very responsible when it comes to purchasing a home and how much home you can afford and want to buy.
Sure.
At the end of the day,
One
and
of
I
the
think.
things. Go
Uh-huh.
ahead.
Well, I was just gonna say, I think that's what we try to really advise on. We're not financial advisors; we're mortgage advisors at the end of the day. But it's important to bring those things up because we don't want our borrowers to feel homeowners remorse right after buying the property, and then they come back and they have a negative you know I
Yeah.
memory of you
Yeah.
at the end of the day. So you can let them know and educate your borrowers, but at the end of the day, we can't make the decision for them. You
Yeah.
know. Uh,
Yeah. One of the things I've been busy this last year is dealing in a lot of dissolution of marriages and getting
mhm.
appraisals and doing that. And I was always curious because I'll hear the client talk about, yeah, I'm hoping to be able to buy him out, but not
Right.
everybody has 300,000 large or whatever that equity is to buy them out. Is there any special loans or programs for people that are getting a divorce, or do they just have to go through the typical refinancing?
Yeah, typically you have to go through the typical refinancing. Make sure that one of the two borrowers can actually afford the home. Whoever's keeping it, and making sure that they meet all the criteria to be able to qualify and afford the payment on
Mm,
their own, right?
wow.
Especially if there's going to be a cash out. Tapping into the equity to divide some of the proceeds from the
Yeah.
property, or the actual capital that's within the equity that's built into the property,
Right.
paying off the ex-spouse, right? Because they owe them X amount that was dictated through the courts. So that's something that can be very, very hard, right? Especially not everyone has, the same amount of income. Maybe they haven't been working for the last 2 years.
Yeah.
So sometimes the best solution ends up being, selling the property and
Wow.
everyone taking the proceeds and walking away,
Yeah.
right? But
Yeah.
some individuals are very tied to that property, or it's about who can
Yeah.
win, right? So they get into this race, and maybe they end up in a crunch like that, the debt to income ratio again, that
Yeah.
a lot of a huge portion of their income is going towards the monthly payment, towards their monthly liabilities, just because they're trying to essentially win,
Hmm.
and their divorce.
Yeah. Yeah. And then what are you seeing? Because like when I listen to CNBC and they talk about like credit cards have exploded, over and especially the last couple of
Mm-hmm.
years. Are you seeing people trying to refinance their house to pay down that debt? And what if they are, say they have a good strong earning, but yet their credit card debt has pushed them? Is there any things that people can do, um, to you know to help them? Like, because right now, like, say they're just robbing Peter to
Mm-hmm.
pay Paul. Is there programs out there that help people that are, like a good example? Let's say you
Mm-hmm.
locked in at 2.5% back in '01 or 21, and you got a killer rate, and you don't want to necessarily leave that, but yet to get by, you've got credit card debt, and you do want to
Yep.
tap into that equity and say there is a lot of equity. Would the banks even still dare to to loan you if you have crazy credit card debt?
Yeah, so it comes back into play, right? That debt to income ratio. In a lot of situations, let's say, we'll give two scenarios. One is they're in that 2.5% rate, 3%. They don't want to get rid of that rate ever,
Yeah,
right? But they have a huge amount of debt that's piling up on their credit cards, on their car loans, and whatnot. Um, and credit cards, the interest rates on those are 24%. The car
yeah,
loan, it could be 6%, whatever it is. At the end of the day, they have these huge payments and they're just financially stretched.
yeah,
So, a good way to leverage our some of our programs is through the home equity lines of credit or home equity loans in general. Home equity lines of credit are basically like a credit card that you can pay down the balance and then you can run it up, pay it down. I prefer doing a home equity loan. It's you're not in the habit of using it as a credit card. At the end of the day, you got into that financial position of being stretched thin, right? And doing a home equity loan will help you pay off all that debt, or a HELOC for that matter.
right.
And you'll still be able to keep that 2.5% rate, and you'll take out a home equity loan so that you don't touch that 2.5% rate. And this new rate on the HE loan, it might be 7%, whatever it is, during that market. But it doesn't address why you got that
Right.
stretched so thin financially. It doesn't address the behavior behind that. So that's something important to whenever any of my borrowers bring it up. I let them know, I'm happy to do this for you. You're gonna get a much better blended rate because you're looking at the 2.5% plus the new rate. You average it out. It's a blended rate, so it's better than refinancing.
Yeah,
Actually refinancing the first loan, and tapping into your equity and doing a cash out. It's still better. You're reducing all your monthly payments. That's great, but I don't want you to do this just so you end up back in the same position later
right,
on,
right.
right?
Because you'd be
It's
doubly impacted.
Yep, yeah, and sadly, a lot of borrowers, if they don't take care of their financial, situation, they end up back in the same position, right? So it's
So
important. I think. Uh huh.
on a line of credit, are they the same terms as like a 30-year, or are they usually a 2-year or shorter terms?
They'll do. It depends on So we're a brokerage. We partner up with a variety of lenders, and they are all going to have different terms and whatnot. So you can do a 30-year term. It's the same. You can do a 15-year term or a 10-year term. When it comes to home equity lines of credit, though, you're looking at what's called an adjustable rate mortgage, right? So the
Ah,
rate, it might have a teaser rate, they call it, right? So it introduces this nice low rate, at 6% or 4. Depends on who you're working with. For maybe the first 7 years, the first 5 years or 7 years. But then after that, after the teaser rate expires, then it begins to adjust, right? And every loan has a different adjustment period.
mm-hmm.
But let's go with a typical 5 6 arm, so it'll be fixed for the first 5 years. After that 5 year period is over, then it begins adjusting over the next 6 months. So every 6 months it'll adjust, based on the market rate, and the market rate will be typically nowadays it's based off of the SFOR index. Um, so it can fluctuate, right, during that 6 month period. There are caps that now exist to protect the borrower, so
Oh,
maybe
that's
they'll
kind
put
of
like
good.
a
It
yeah,
doesn't
yeah,
shoot
because we
to a
had 2008
12%.
happen.
Yeah.
Yeah, exactly. There's going to be a periodic cap, and then there's going to be a lifetime cap as well. So periodically, it might not be able to adjust more than 2%, above the original rate during that adjustment. But then during the lifetime cap, it might not ever go past 10%. Whereas
Gotcha.
back in 2008, during the mortgage implosion, none of those caps existed, or there were just a lot more aggressive versions of these arms out there, right? So
Interesting.
they have built in a lot of those, protections into arms. And that's typically how the HELOC works. A lot of the times by the fifth year when into that loan, most borrowers will refinance, but you never know what your situation is going to look like in
Right.
5 years from now. The
Hmm.
life changes every minute of our day. um, so that's why I personally prefer a he loan. It's more stable. It's predictable. You're not putting yourself in a vulnerable position in the later future. At the end of the
So,
day.
okay, so HELOC just kind of caps in the long-term rate versus the adjustable.
Yeah, so the HELOC is typically ARM based, adjustable rate mortgage based. There are some fixed HELOCs out there. But it's not very common. The HE loan, it's just a closed end loan. You Once you start paying it down and it's paid off, it's done. Right? It's not like a
Oh, okay.
HELOC where if you pay it off, then you can go out there and borrow more money against the equity of your house again without
Gotcha.
having to go through the process, right?
Gotcha.
So two different products. It'll depend on the borrower and what their risk appetite is, but in my personal opinion, I'd rather put our borrowers in a good position, right?
Yeah.
But
Yeah.
there's some borrowers that are okay with taking on the risk, right? And maybe
Yeah.
they're investors, maybe they have a unique situation. So I'm not, someone to judge and give the financial advice. I can just give you the mortgage advice at the end of the
Right.
day,
Right.
right?
So what are in this current market, what are like some of the top mistakes that slow down or kill a loan?
Um, yeah, so right now in this market, it's something that can slow down or kill a loan. I mean, I think right now it could be the values of the property, right?
Yeah.
Because a lot of people may assume that the property is worth X amount, and the appraised value comes back and it's not worth as much as they thought, right?
Right.
So when that happens, like let's say we went into a negotiation for, you're buying a property for $300,000, and it came back at 290,000 dollars, and you were already under contract, right, for the $300,000. Now we're having to look at, okay, renegotiating or covering that gap in funding,
Right.
right? Because us as the lender will only cover up to the appraised value. um, so then we have to go back to the negotiating table and talk, have the seller and the buyer negotiate through the realtors, real estate agents, and figure out, if they're willing to renegotiate, or if the borrower is okay with putting in that extra funding. Sometimes they just don't have that extra, cash flow to
Yeah.
be able to put that funding,
Right.
right?
Yeah.
So, and not that it's been a bad market. It's actually been a great market. Values are holding, but we're just not seeing, that huge jump in market values like we were, back in
No,
from 2016 to 2020
no,
to
yeah,
2023,
yeah,
right?
no. We've
Um,
as an appraiser, I've noticed that almost across the board, even now in some of these key areas, you're seeing a declining in price. You know,
yep.
it's no longer rip in year after year. You're starting to see values dropping, and I even had appraisal yesterday with the guys like,
Hmm.
really in this area, and I said, yeah. I said, what's happened is
Yep.
the market is adjusting, and people are adjusting their prices because they're starting to finally feel like they can no longer ask that 1.6, 1.7 for that home anymore when the market is clearly dictating it's a 1.5, you know, even if it is
Right.
the only one or two homes available, the market is just not supporting it. So we definitely have seen, especially I'll say in that 900,000 to a million or to 2 million, you're really seeing massive adjustments. But homes that are under 600,000, they're steady. They're okay,
Yep.
you know, because that's feasible for most of the buyers, you
Hmm.
know. But that
Right.
900,000 to 2 million, that's a different buyer now, you know, and it's not
Yep.
as easy to close that loan, or it's not as easy to qualify. Like you say, if you got $1,000 truck payment plus a little bit of credit card, even if you are making six figures, that house payment at today's interest rates, pretty good chunk of money now, you know.
Yep. Yeah, and there has been a lot of cash buyers. That's
A
what I've
lot of
seen, and
cash.
that's what a lot of cash buyers. And just with conversations with some of our title partners and real estate partners. A lot of cash buyers out there, but not everyone's a cash buyer.
No.
Some of our borrowers are just are most of our borrowers are just regular people like you and I that we're not making gazillions. We just we we're in that market, looking for homes priced from 300 to 600,000.
Mhm.
I mean, depends on what type of borrower you are and what your income is, um, but yeah, there's a lot of cash buyers out there. A lot of them are from out of state, and they're coming into our market because it's a lot more affordable compared
Yeah,
to the markets that they're coming from, right?
absolutely. Yeah.
So,
Well, Eddie, uh, tell everybody where they can find you, because can't believe it. We're already wrapping up almost 2 hours, and
oh wow,
it
time
goes
has
by fast.
flown by.
Yeah.
No, time
So
has flown
tell
by.
please tell everybody where they can find you, and where you're
Yep.
located.
Yep. So we're located here in Tucson, Arizona. We're EHG Mortgage, Independent Mortgage Advisors. We're here in the heart of Tucson on Campbell, between Prince and Fort Lowell. But our company is actually pretty much fully digital at this point. We have office space here to meet in person, of course, if our clients would like to meet in person, but most of our clients can apply online, and we handle
Yeah.
the whole transaction over the phone or through Zoom, whatever their preference is. So we can have someone in Lake Havasu purchasing a property and using us as their preferred
Nice.
broker.
And
But
what's
yep,
that site?
and so, yep, we go through www.ehgmortgage.com. There's a nice big apply now button. And when you hit that button, you can immediately start your application. It'll send you a need list of documents that we need from you. We'll contact you, within an hour. um, it, we're we're focused on being fast, right, and
Nice.
being able to meet all your needs in time. And sometimes you can just also, or if you prefer, it's always better for everyone, just calling us at our company number at 520-526-9944. Whatever your preference is, we work, based on what your preferences are.
Nice.
And at the end of the day, we work for our borrowers, not for the banks.
Nice. Well, Eddie, I appreciate you coming on, and it's been good. And I was glad we got to do a little bit of back and forth, you asking questions on me, because a lot of times it's me driving the questions. So it's kind of nice to get a little more info from me to you so that you can take that forward. So it was a good chat,
Yep,
man.
absolutely.
All
Absolutely.
right.
No, thank you very much, Gary. It's always a pleasure. Thank you so much
Yeah,
for having me on your podcast.
of course. All right, buddy. I'm going to stop the recording now.
Okay.